Hello everyone, and welcome to today's webinar, GovCon Accounting 101, Contract Types and Pricing. My name is Mark Steiler. I'm a Senior Marketing Analyst here at NeoSystems, and I'll be your host for today. Before we get started, I want to take a quick look at today's agenda. So in looking at the registration list today, many people on today's webinar are actually new faces to NeoSystems. So what we wanted to do is give an overview as to who we are, what our experience is with government contracting, specifically with the accounting and financial management principles that are applicable to government contractors. After that, I'm going to turn things over to Chen, who is today's featured presenter. He's going to walk you through the four main types of contracts that we find out in the government contracting market, those being firm fixed price, cost plus award fee, cost plus fixed fee, as well as time and materials. After that, Sean's going to review some best practices for pricing, showing you how to build up a fully burdened indirect rate, as well as forecasting provisional rates for optional years of contracts. And finally, he's going to address some of the limitations of both QuickBooks and Peachtree and how these solutions might hold you back from really getting the full picture of your financial situation within your accounting system. And as always, we'll have time at the end for Q&A, so please submit your questions along the way. We tend to address these in a first-come, first-served basis, so you definitely want to make sure that you get them in on time so that we can answer them. One question that we always get from people is, will we make the slides available? We actually always publish a recording of the presentation and put it up on YouTube. So make sure to check your email next week. We'll send a follow-up that'll have a link for that. So let's take a look at who we are at NeoSystems. NeoSystems was founded in 2000 as a firm that primarily did accounting and financial management solutions for government contractors. But today, we're really much more than that. In 2003, we partnered up with Deltek and are now a Deltek Premier Partner. In fact, we actually have more collective Deltek expertise than any other partner out there on the market. In 2010, we became an IBM Business Partner, and we are now an IBM Advanced Business Partner. So we work a lot with the Cognos toolset and helping to integrate that with the Deltek accounting and ERP platforms. To date, we have a little over 120 employees, and we serve over 400 clients, which represent an employee base of 23,000 people. So that's really quite a lot of government contractors that are reliant on us on a daily basis to manage various different components of their back office. And what we say we offer today is strategic back office services, which encompasses accounting and finance, human capital management, as well as IT services. So let's take a look at some of those back office services. Really, our flagship solution is what we call a managed accounting service. In this model, contractors are actually outsourcing their accounting and financial management operations to us. We make sure that they're compliant with both the cost accounting standards as well as the federal acquisition regulations to make sure that they never fail a DCAA audit. And actually, we contractually guarantee that you will never fail an audit as part of our services. One of the more interesting aspects about our managed accounting service is the fact that we utilize our own licenses of Deltek. So you don't have to actually go out there, procure any of the software, worry about license bans and everything like that. We manage all of that for you. And then we also host all of your accounting data in one of our secure private clouds. So we actually have 3 hosting centers that are located strategically across the United States on different power grids to ensure that availability is always optimized. Our hosting center is SSAE 16, SOC 1 and SOC 2, PCI DSS, MA 201, as well as ITAR compliant. If you're unfamiliar with some of those terms, those are a lot of the hosting accreditations that contractors are really looking for when they're choosing a provider. So we make sure that you have all those boxes checked. We also do a lot of consulting around both the Deltek and IBM Cognos brands. I mentioned earlier that we are both partners of those organizations, and so a lot of companies come to us and ask us to help them convert to Deltek from a solution like QuickBooks or Peachtree. We also do implementations on the Cognos side as well. So Cognos 10 is the latest reporting tool that they have in their business intelligence suite, as well as Cognos TM1, which is more on the budgeting and forecasting side, and Cognos Express as well. If you've been on a Deltek or Cognos solution for quite some time, we also do re-engineering of these. Chances are that when you first implemented them, you've grown a little bit since then and your needs have changed a little bit. So we'll help you update your software and make sure that it meets your current needs. And finally, just a few other areas where we offer assistance for compliance. For many contractors, your incurred cost submissions are due on June 30th, later this month. So we do offer support in helping you manage either the full spectrum of that submission or particular schedules that might be tripping you up. Some of you on the webinar today, I noticed, were on our incurred cost submissions webinar back at the end of March. So definitely use that as a tool going forward as you're getting ready to submit your ICS. If you weren't on that webinar, you can check out our website. We've got a link to the recording up there. And finally, we've got also a policy and procedure management service. This is one of the first things that DCA is looking for when they come into a business to do an audit, either before you win an award or afterwards, wanting to make sure that you have electronic documentation of all the accounting procedures, that they're done in a very standardized way, and then also your HR policies too, making sure that all of your employees are recognized and that accept the policies out there related to ethics and various other components. So before I turn things over to Sean, we just want to do our first poll of the day. And what we really want to find out today is what is the biggest GovCon accounting challenge that you have. GovCon accounting is definitely a very niche skill to have. So is it having a staff with limited GovCon accounting expertise? Or are you operating on an inadequate accounting system like QuickBooks or Peachtree, and is that keeping you back from really getting the full financial picture? Is it knowing which compliance requirements apply to you? That can be really tricky for people to navigate the CAS and FAR and figure that out. Or is it seeing a high-level overview into your financial performance or pricing? So we'll go ahead and keep this open for just a few more seconds. So feel free to get those responses rolling in. Okay, and we're going to go ahead and close the poll. And let's go ahead and share the results with you. So looks like we have an even split for a third each between having the staff with limited GovCon expertise as well as knowing which compliance requirements apply to you. So if you did select the knowing which compliance requirements apply to you, we're actually going to be holding another webinar that's very compliance focused, probably in July at some point. We don't have a final date for that, but definitely make sure to check our website. We'll also send an email about it as well, and that will definitely be a great resource for you to use moving forward. So with that, I'd just like to introduce Chen, who is our featured speaker for today. With nearly 20 years of experience, Chen is a leader in the field of government contracting, accounting, and financial management. His experience includes migrating companies from solutions like QuickBooks and Peachtree to the Deltek product suite. He also helps companies develop competitive provisional and indirect rates and helps ensure that companies are compliant with all the federal regulations that apply to them. As part of our managed accounting services team, Sean is responsible for delivering strategic financial management advice to his clients, as well as overseeing the daily accounting operations. So with that, I'll turn things over to Sean. Take it away.
Hi, thank you, Mark. Thank you, everyone, for joining us today. We have a lot of material to get through, and I want to ensure that there is some time left so that I can answer you all's questions. So the contract types that we're going to be going through today are firm fixed price, cost plus award fee, cost plus fixed fee, and time and materials. There are obviously others, but we can't cram all the other contract types into a 1-hour webinar. So that we can go into those during the questions and answer segment. So the contract type risks. For each contract type, there is a risk for the buyer or the contractor, such as yourselves, and also the government. As you can see from the buyer's or contractor's perspective, firm fixed price, the FPI stands for firm fixed price plus incentive. Those are really low risks for you as a buyer because essentially you can maximize profit based on a fixed price job. From the government perspective or from another company perspective, it offers them high risk because they could be essentially giving you a lot of funding, but you're able to do the work in a relative short span of time. TNM is pretty much 50-50 between the buyer and the seller. And then as you get closer to the cost reimbursable type work, cost plus award fee, cost plus fixed fee, on the buyer's risk is very high. So essentially, your profit margin on those contracts range from anywhere between 2 to 8%. Anytime you have rate variances over your fringe rate, for instance, if your fringe rate is at 30% and you bid it at 30%, and you end up the year at 35%, well, you've just cut into basically your profit. So that's why it's a very high risk for buyers or contractors. Usually the contractors that are already established with DCA or are ready to have a DCA representative come in and do a system audit, those are the type of companies that usually go after cost plus work. And then from the government perspective, it's very low risk to offer cost plus work to contractors, obviously for really logical reasons. So the first contract that we'll discuss today is the firm fixed price contracts. Firm fixed price contracts are awarded when definite performance specifications are available within the RFP. The government already knows exactly what type of deliverables or milestones that they are expecting, and then that's usually when they come out with a firm fixed price RFP. Always fair and reasonable prices can be established at the outset from the government perspective, and set price for work to be done. These definitions can be found in the FAR 16.202-2. So the benefits for firm fixed price is, again, maximum profit potential for you as a contractor. If you get awarded a $100,000 job and you bid, let's say, 8% on that job, you basically have $100,000 worth of funding that you can basically set up your company so that maybe you can do the work for $75,000. That's why it's very beneficial for you as a buyer to have a firm fixed price job. It also gives you incentive to control costs, improve profits, and ensure that you meet your deliverables or milestones. Pricing on firm fixed price is typically less complex. So what are the risks? Some of the risks for these types of contracts is that you as a contractor assume full cost responsibility. So if you bid $100,000, you need to basically ensure that your labor and materials are all going to fall under that specific funding value. Obviously, the closer you get to that ceiling, the less profit you make, and then ultimately, if you go over that ceiling of $100,000, then you're working pretty much at a loss. In these days, all RFPs, or most of the RFPs other than in the Intel industry, are all lowest price, technically acceptable type RFPs. So these fixed price contracts demand high performance and schedule risk for the contractor. And you really can't overlook recouping your indirect costs that are associated with this type of contract. So if your indirect costs, what that means is that if your indirect costs fluctuate year upon year or even on a monthly basis, we'll just take fringe, for instance. If you bid it at 30% and your fringe fluctuates 35, 40%, you really can't recoup those types of costs. You just have to build it in within the funded value that the government gives you. Okay, so the best practices for these type of contracts in the bidding process: know all the impacts of the contract requirements and specifications. Basically, read the cost volume, read the RFP very carefully. Include well-defined accepted criteria to know when tasks are complete. So if you have milestones within your fixed price contract, or if you have deliverables, know when exactly those are completed. Be sure work can be completed for your proposed hours and costs, and obviously prevent any subcontractor overrun. And really what that means is, if you're a prime that was awarded a firm fixed price job and you have some subcontractors on there, sometimes your subs could be offered a TNM type work or even a firm fixed price. On the TNM side, you can easily overrun your costs because you're offering your subcontractors a time and material basis, even though you as a prime, you have a firm fixed price job. So sometimes subs can kind of take advantage of that, and obviously they're going to bill you for their costs, which will impact how much profit you make on the job. So be wary of that. All right, next one we'll get into is TNM contracts. TNM is really suitable for use when the seller can't accurately estimate the extent of the work, the duration of the work, or really anticipate any cost with a degree of confidence. More defined definitions can be found in the FAR section 16.601. And some of the risks that are associated with time and materials, the profit percentage for time and material can be very good. At the same time, you can really kind of hurt yourself in a time and material type basis because of what you originally bid. So during the original RFP or the cost volume pricing development, you might already have an in-house resource that you want to go ahead and bid out. So then you add in fringe, overhead, and G&A, put in a profit percentage, and you end up with a specific bill rate for that first year of your contract. Well, let's say that employee leaves, and he was, making $80,000. And then you find another replacement, but that person, demands $120,000. Well, you're stuck with that bill rate. You can't go back to the government and say, oh, by the way, I've, added someone more expensive. Can I increase my bill rate? So essentially, you're stuck with the bill rate. That's a risk within TNM contracts. Now, vice versa can happen. You can have you bid an $80,000 employee. That employee leaves, and then you find someone that can do the work for $70,000. That greatly increases your profit on the bill rate. So we already talked about the internal rate changes that will increase labor costs, reduce profit over time, and they can be pretty difficult to staff projects. So if the government comes back to you and says, hey, I need another resource, this will be a new job description, how fast can you get that employee in? Well, there's a lot of negotiations that go on within that. You can't just, for instance, for a firm fixed price, you can just add in another person. With a T&M job, there's a little bit more complexity to responding to the customer requirements. So best practices, propose higher than normal rates. A good guideline to use is some type of resource website such as salary.com that can take your geographical location and say, okay, well, a Java developer makes this in your area of the country, and you'll be able to base your rates off of those average or high-level salaries. Ensure forward pricing rates cover average of future costs. We'll get into provisional rates later in the slide, but essentially you want to forecast out what your company or what your financials will look within the year or the next year so that you can anticipate what that's going to cost the government, and then you're going to give them those provisional rates and build your labor rate off of those provisional rates. And then another best practice for time and material contracts are a lot of times those labor categories have certain limits in the amount of work hours that are proposed. So instead of limiting the actual labor category hours where you could potentially shoot yourself in the foot, try to limit total hours of the job, not by labor category. Okay, so next one we'll get into is cost plus fixed fee type contracts, used only when uncertainties involved and contract performance do not permit costs to be estimated with sufficient accuracy to use. Basically, the government has a significant amount of work to be done, but they can't really distinguish how much it's going to cost. So in that case, they ask contractors, hey, give us a bid let us know how much you can do this type of work, how fast, and then they usually pick based on the price. Again, we'll talk about profit. Literally, on the cost plus fixed fee type work, your profit is limited between 2 to 8%. So any type of overrun in your indirect rates really shrinks and puts you as a contractor at risk for very minimal profit or no profit at all. The benefits. There are some benefits to cost plus work. One is that it really gets you on the DCA map. That can be a benefit, and that can be actually a disadvantage for a company as well. But it gives you almost like an ace in your pocket saying that, hey, I've been reviewed by DCA, I've gone through a system audit, and DCA's found my company adequate to bill the government. That's an advantage. You also get to recoup all of your allowable direct and indirect costs associated with the contract. So only, and I should have put an asterisk in here, only if your rate exceeds what you've proposed. So I'll go back to fringe. If you've proposed 30% and you ended up the year at 35%, you could essentially go back to the government if there's funding left over and say, I've had an overrun in my fringe of 5%. I'm going to go ahead and bill you the difference. Government, most of the times, will go ahead and pay you that particular difference. On the other hand, if you bid 30% fringe and you end the year at 25%, you actually owe the government back money because you've billed them for more than what your fringe was worth, essentially. Also gives you some flexibility when estimating costs, and we can kind of get into that, what that means when we go into the provisional rates. So with some of the advantages, there are, I say, a lot of disadvantages for having cost plus work. The government is not obligated to reimburse contractor for costs. So the same scenario, if you bid 30% and you ended the year at 45%, let's say, the government's not going to pay you that difference. They might give you some of it, but if you've just vastly bid inaccurately and you ended up 15% over what you bid, government most likely won't reimburse you for that. Have to notify your contracting officer if your cost estimates change. If you've had some unforeseen cost, large expense hit your company, you can usually go back to the contracting officer and say, hey, we didn't forecast this out. This is what it does to our rates. Can we adjust? Most of the time, the contracting officer will oblige. You're subject to DCA audits, system audit, and financial audits. And you are subject to submitting what's called an incurred cost submission. So an incurred cost submission is basically a book that DCA uses of your financials. It has all costs associated with it, and they use that as their guideline for when they come in and audit your financials. They want to make sure that your costs are in line, that costs are being allocated out correctly, and that labor and invoicing that you are performing to the government are done correctly. It's essentially just almost like a CPA audit. And then lastly, you have to ensure that your costs with billings are in line with what you estimated. So back to fringe. If you estimated 30% fringe, that's what the government is expecting the bill for. You can't add in 32% one month, 38% the other month. It must maintain at that even 30%. So best practices. Watch contract costs and funding very closely. If you have an accounting system that's able to distinguish between targeted rates or provisional rates and your actual rates, you have an advantage right there because you're able to monitor those costs. You're able to see where you're over or where you're under every month. And obviously the reason why you need to watch your costs is that you don't want to be too over and you don't want to be too under your proposed rates. Again, notify contracting officer of needed funding. Monitor your contract for scope creep. That happens very often in cost-plus type work because the government is very unsure of the amount of effort that it'll take. So obviously, if the scope does change, you need to notify your contracting officer. Work off of provisional rates and adjust those rates each year. Notify DCA of any changes to your indirect rate structure. You could have essentially going after a cost-plus type work, and you're not building in, let's say, a material handling rate because now that you're offering subs some work, it'll probably lower your G&A. So some companies like to develop what's called a material handling rate. So if you develop a new rate and you've already sent in a bid, notify DCA and your contracting officer of those changes. And more likely than not, they'll go ahead and structure that contract. And then to piggyback off of that, no fee on top of fee. A lot of small to mid-sized government contractors, when they do get awarded a cost-plus work, make this mistake. So in an instance where you have subcontractors, and let's say you offer the subcontractor a cost-plus type work as well, they're going to go ahead and build in the raw labor plus fringe and any other indirect burdens that they have, and then they're going to go ahead and put fee on top of their costs, right? So if the contract states you as a prime, you can't have, let's say, you can't bid over 8%, typically what will happen if you don't have an advanced accounting system or you have an employee that truly doesn't understand cost-plus work, a lot of times what happens is that those sub-costs that you get, you're going to go ahead and have fee on top of that as well. So you'll have your labor plus your indirect rate burdens, maybe some ODCs, maybe some travel, and then you'll have your sub-costs. And a lot of times subcontractors will put 8% on top of all those costs. So essentially you have fee on top of fee. When that happens, it's a big red flag for DCA, and it could get you as a company in trouble. So cost-plus award fee contracts are essentially the same. I'm not going to go through a lot of the same type of stuff, but essentially it's the same, but there is a performance or achievement aspect to the contract. Government's still uncertain about how long it'll take, what the level of effort is, but they realize that, okay, well, I want a certain milestone to be reached. And if you as a contractor can achieve that milestone and achieve above and beyond what you proposed, more often than not, you're going to get an award fee which ranges anywhere between 2 to 8% on top of your 2 to 8% that you bid when you submit the RFP. So the benefits, award fee may be earned in whole or part during contract performance. Usually they range anywhere between quarterly, semi-annually, and annually are for the award fees. Again, you can recoup pretty much all your allowable direct and indirect, and you have flexibility. So some of the award fee risks are that since you've been awarded a cost-plus award fee type contract, you're not guaranteed that award fee. I don't know any company that I've dealt with that have been given 100% of the award fee. If your performance as a contractor is marginally acceptable or even unsatisfactory, chances are you won't receive an award fee. And again, the award fee determination is strictly on your contracting officer. And if they give you 1%, you can't appeal that. And then obviously, cost plus, any type of cost reimbursable type work is subject to DCA audits and incur cost emissions. So award fee best practices: maintain satisfactory performance throughout contract. If you can get the work done in less than what was the original contract value, that could result in an early award fee. And then same scenarios for cost plus fixed fee. Watch your contract costs and funding closely. Notify your contracting officer of any changes, and work off of provisional rates or forecasted rates. All right, so we basically ran through some of the basic contract types, and we'll now get into pricing, pricing principles, pricing best practices, and why we price. I mean, obviously, you want to increase cash flow. You want to increase profits for your company. In some cases, you might want to go ahead and price lower for a certain RFP just to get that revenue growth. And obviously, in that type of scenario, you would want the revenue growth, the past performance in the industry or market that you're going into, and a piece of the market share. So some of the characteristics of pricing that are very important, obviously have a clear identification and understanding of the tasks within the RFP. Broad participation in pricing preparation. Sometimes small contractors only have one pricing person doing the whole cost volume. That's a liability because they might have incorrect information. There should always be multiple people involved in the cost volume and the pricing preparation. Having the valid data available, and we'll get into primary sources for data and secondary sources for data. Have a standardized structure for estimating. If you use a budgeting tool, whether it's a spreadsheet or another application, try to standardize that for all your pricing on the RFPs. Recognize inflation. When you bid base year plus option years, make sure that you have an escalation factor in there, whether it's 2% to 3.5%, whatever you feel comfortable with. And recognize excluded costs and burdens. Don't include alcoholic beverages in your overhead costs, for instance. And revision of pricing estimates for significant program changes. So if an RFP comes up with an amendment and you've already basically completed your pricing, revise those things so that revise your pricing so that it gives you the best advantage as a company when it comes to the selection. So this chart here shows a primary and secondary where you can get information and data to complete pricing in your cost volume. Obviously, the primary side includes accounting records, cost reports, all of your historical database so that you can trend out what your forecasted rates will look like, your labor distribution reports. For those on the advanced accounting system, if you have indirect cost reports, printed out, those are good. If you maintain them on a spreadsheet, they work as well. Obviously, having SMEs, recruiting, and technical bases are all really primary sources for pricing and developing the cost volume. And you'll notice that in the secondary column, some of those overlap, but then you have previous cost proposals, contract estimates, research papers, competitor intel. If you have a really good BD person in-house, a lot of times they'll know what your competitors' wrap rates are, what they were awarded for a similar type of contract. Having focus groups, red team, blue team within your proposal team, and surveys are all good sources of data. So major risks in contract pricing. This is where a lot of contractors get in trouble. in pricing, and even though you might have a great technical approach to the RFP, if your pricing is shabby and it and it has a lack of buyer understanding in the RFP requirements, or if you're trying to piece together pricing within a week to 2 weeks, these are all major risks, and for you as a contractor to not be awarded the RFP. Sometimes, and that's why it's really good to have that broad participation when developing the cost, volume, and pricing, because you could have one person could understand the language in the RFP one way, and another person reads it, and it could be completely different. Deception. If you have a pricing person that's solely responsible for pricing, they might think or say, yeah, I've completed the pricing for you. I've used these rates. Come to find out maybe that the rates are completely different or they're incorrect. So that's why having multiple resources work on pricing is very important. And then last is the poor cost estimating and forward pricing practices. So with that, I'm showing you essentially how to build up your hourly rate. And in this case, it's really for a time and material type job, but it also gives you a way to come up with how much the total employee will cost, whether it's on a firm fixed price or a cost plus type work. Okay, so this salary of the $48.08 is based on a salary of a $100,000 employee working 2080 hours a year. And let's assume that the fringe is 32%. Okay, so you're going to take the 4808 times the 32%, and it gives you $15. Then how you burden, when they say a fully burdened rate, then you're going to take your next indirect rate, which I'm assuming most of you all have an overhead rate. Some of you all might have multiple overhead rates. Depending on what type of overhead rate you're going to bid, you take in the hourly rate plus the fringe rate, and then multiply that by your overhead rate. And in this case, it's 24%, so it gives you another $15. So if you have G&A, most of you all do, then you take a combination of the fringe, overhead, and the raw labor, and you multiply that by your G&A rate. So as you can see in this example, your total cost for the employee is not just $48.08. It actually costs the company $84.99 to keep the employee employed and happy. So, okay, now you can come up with and say, all right, I want to make money off of this employee. And depending on what the RFP requirement is, you build in that fee percentage. So in this case, we just use 10%, adds in another $8.50. So your total bill rate for the employee is $93.48. And you can take that and build that into your pricing matrix. So what I wanted to show you is that this is, let's say, you've already established provisional rates, or you want to work at actuals at the end of the year, and this is what you end the year at. So then, so this is how you essentially build up a rate and figure out how much an employee costs a company. So in RFP and government contracting terms, wrap rate is thrown around there. Typically nowadays, a lot of contractors and BD folks will say, hey, I need my wrap rate to be around 1.6 or 1.5. Well, this is how you come up with your own wrap rate within your organization. Assumptions are fringe, just using the same percentages, fringe, overhead, and G&A. The calculation is 1.32 times 1.24 times 1.08 gives you a total wrap rate of how much the employee costs you, okay? So in this example, it's 1.767, and it's kind of in the middle towards the higher end of what's a good range to be in nowadays type RFPs. Intel work, you probably need to be a little bit below or right around 1.5. Housing, urban development type work, a higher range is okay, but that's a pretty good range to be in, is a 1.5 to 1.8. So when you're able to come up with a fully burdened rate that includes fee, then you can throw in, okay, now my labor matrix has been completed. So now you can take the hourly rate, know what the hourly rate is, and throw in the fringe, overhead, and G&A to come up with a fully loaded rate. And in this example, that's essentially what the government would like to see. All RFPs have their own matrix that they want to use, but this is an example of what they'd like to see. They like to see how things are broken out, how you come up with fringe, if your calculations are correct, and how you come up with a fully loaded rate. So in some of these slides that we've been talking about, we're talking about provisional rate or forecasted rates, okay? Provisional rates are essentially towards the end of the year. You take all of your costs from either the same year or a previous year, and you combine the two, and you say, okay, I ended up the year at fringe at 30%. Well, I'm going after 3 RFPs that's going to increase my employee FTE count by 20 employees. So then you plug in those 20 employees, you know what their salaries are, you also plug in any costs associated with those employees, and figuring out what the revenue as well would be for those RFPs if you win, you can come pretty close to what your company is going to look like if you win those RFPs that you're going after. How it works is that, okay, yeah, you might not win one, but then you're going to go after another RFP, so it kind of replaces that. So you can pretty come close to what your company will look like. And in most cases, it lowers your wrap rate when you develop a provisional rate. So if you're typically at 1.8 every year, and let's say you want to go ahead and forecast out these rates this year, you might be at 1.67, 1.7, but the beauty of that is that, okay, you're giving the government forecasted rates, but at the same time, you have more of an advantage of winning that work. So the lower rates that you have, the more chances you have of winning that work. Anytime you win work, it decreases your indirect rates. So that's pretty much how that works out, okay? So they're really used for both pricing and billing on cost-plus type work. That's where the billing would come in. You have to reconcile your actual costs versus your provisional rate costs, either at the end of the year or when your contract ends. They can be audited by DCA. You can always submit provisional rates. You don't have to have a cost reimbursable type work to submit provisional rates. You can actually just say, hey, I use provisional rates as a company to give you that edge when you go after an RFP. But DCA uses your provisional rate budget as a frame for reference when the auditors are reviewing either proposals or your billings. And they are used really for billing for your existing contracts and, as mentioned before, pricing new work. Any change within your provisional rates when you have cost reimbursable type work, you have to have that data supported by either actual financial statements that have that rate change, and anytime you have a change in indirect rate structures, that could spark basically a red flag to DCA, and they could come back with a lot of questions. So in this scenario, I'm showing you the difference between the actuals and the provisional rate. On the left-hand side, this is where you ended up the year at. Your fringe 30%, overhead 25%, and G&A at 9%. So as you can see, your wrap rate is 1.775. Now, the advantage of having a provisional rate is that you forecast out added extra cost, added extra base. And what that'll typically do is lower your indirect rates, okay? And in this case, now you're coming in at a RAP rate of 1.589, which is very competitive and much more competitive than 1.775. So that's really the snapshot of the advantage of having a provisional rate. So then here's another example of a pricing matrix. And the other matrix, it showed how you build up that particular fully loaded rate. So now you're going to take the same loaded rate and then you build in, depending on how many option years there are within the contract, you build in escalation factors. I think in this case it's 3.5%, so that the government can see, okay, well, what's it going to cost base period, and then my extended option years. Again, some of the advantages in developing provisional rates, most important, you get competitive pricing. You have really advanced capabilities in estimating and forecasting. Once you develop provisional rates, they essentially act as your company budget. So even if you don't have an advanced accounting system, if you're able to develop provisional rates, you can actually see where you're over or where you're under every month. And that's the beauty of developing provisional rates as well, is that you've already essentially built your budget. Again, being able to compare actuals versus target gives you the ability to monitor and to control costs. If your fringe is too high and you know you're accruing and expensing, let's say, bonuses at $20,000 a month, hey, well, you can reduce that accrual significantly if your rates are too high. Same thing with maybe your G&A costs. A lot of small government contractors and mid-sized government contractors really struggle with G&A. So this gives you the ability, if you want to be at G&A at 12% and you're really operating at 28%, it'll give you insight as to maybe you can control some of the costs, or you can even actually cut some costs. And sometimes it's an advantage, sometimes it's a disadvantage, but DCA interaction. More that you're on DCA's radar and you're in compliance, the more likely you are to win that type of work. So obviously, pricing and cost volume, it's all about following directions. That's pretty simple. If you can't follow directions, or you miss a certain piece within the cost volume, doesn't matter how good the technical approach side is, most source selectors will go ahead and throw the RFP out. So we've talked about advanced accounting systems and what the advantages of having an indirect rate report print out for you. Here's some limitations for QuickBooks and Peachtree. DCA, they will pass a QuickBooks system audit, but if your system isn't set up very thorough and you don't and the system is set up so that it's not very disciplined, one of the problems with QuickBooks and Peachtree is that you can go back into any month and modify a number. Most compliance systems require that the system be able to complete a hard close so that any adjustment that you have for a prior period will be done in that particular current period. Okay? The QuickBooks and Peachtree application really doesn't give you advanced reporting as far as indirect rates, cost reports, job summary reports, and those are pretty much things that DCA looks for when they do a system audit for you. And again, lack of automatic rate calculation. QuickBooks, you can extract the data out of QuickBooks and basically populate an Excel spreadsheet. Excel spreadsheets are fine, but sometimes they can be complex, and the more complex they are, the more prone to error. And most importantly is that you have to have written policies and procedures as a company to even start to go after really any kind of government work. because really at any point in time, DCA could just give you a memo and say, hey, we want to review your policy on timesheet keeping. If you don't have that, you could be on their bad list radar, and you don't want that. So. Okay, so that pretty much concludes the body of the webinar. I'm going to go ahead and turn it back over to Mark Stadler, and once again, I want to say thank you all for joining us.
Yeah, thanks a lot, Sean. It's a lot of great information. I hope you found it as beneficial as I did. So we're going to do one final poll before heading into the Q&A section, and we want to know that if you're on QuickBooks or Peachtree, what's the biggest challenge that you're currently facing with the application? Many people who come to us looking to upgrade to a Deltek solution say that they're able to modify the closed months. That's something that Deltek, or something that DCA rather, is certainly raises a red flag about. So that's an important one. Actually, the last option, no automatic rate calculations, can really be a burden on small companies, like Sean mentioned, building that out in an Excel spreadsheet. And once you get, with multiple tabs and macros and everything, it can really get quite complex. So we're going to go ahead and leave this poll open for about another 10 seconds or so. Let your responses trickle in, and we'll share it with the group. Okay, we're going to go ahead and close it, and we'll share the results with you. And kind of to no surprise, 71% of you know automatic rate calculations. That's really a burden for small companies, as I mentioned. And so you'll definitely want to evaluate how that kind of fits into your whole back office strategy and see that, if you're looking for a more streamlined way, a more systematic way that DCA recognizes, you might want to think about bringing the solution that does that for you. And that's definitely something that the Deltek products have functionality for. All right, so with that, we want to share a couple of resources that you can use as you're getting ready to do various accounting and financial management operations of your business. As Sean said, one of the things that you really need to keep in mind is to follow directions. So here are 5 great resources that are out there that really give guidance in terms of what accounting regulations apply to you, how to sufficiently structure a cost proposal and make your proposal really be reflective of what the government's looking for. So DCAA, always make sure that you're up to date with changes that come out of there. They do update that pretty frequently, so you want to make sure that you're on the cusp of all those changes. As well as the third bullet there, the FAR too. It can be a little daunting to go through that, and I wouldn't recommend doing it after a turkey dinner because it'll probably put you right to sleep. But it's certainly something that you need to be aware of. And in terms of resources that we offer, if you are on one of the Deltek applications, we offer a suite of accounting training courses on those to really get you familiar with the core processes that are in each. So processing accounts payable, managing a general ledger, running payroll, things like that. For those of you who are out there on CostPoint, we actually have a blog dedicated to the upgrade to CostPoint 7. Deltek is retiring support for the current version of CostPoint effective October 1st of this year. So that's a big upgrade. A lot of companies are going through right now, and there's a lot of great resources out there for you. If you do have any questions that you want to submit off the webinar, feel free to reach out to us at growahead@neosystemscorp.com, or here is the email address for Sean and I personally. With that, we're going to open up the questions here and get to some of the ones that were submitted. So if you haven't submitted your question yet, feel free to bring them in. Yeah, and as always, we do have a couple questions about making the presentation available. If you give us till about Tuesday of next week, we probably will have the recording up on YouTube. And if there's any delay in that, we'll send you out the slides. But definitely keep an eye out for the recording because that'll have the audio to go along with it and will certainly be helpful.
All right, so most of the questions were about the slide. There is a question about the rate calculation. Can you go back to that slide? Okay, so next question, of those sites that was listed, which site is best to see what compliance is required for small business? You can really go to the actually the SBA website and also DCA.mil. DCA will be obviously geared towards all types of government contractors, but there are some advantages for small businesses, such as different certifications for 8A, women-owned, small disadvantaged business, veteran-owned business. And the advantage of that is that you know, the SBA website will have instructions and basically a map of how you can get those particular certifications. When you get those certifications, obviously it gives you an advantage in winning some work, because in FedBizOps or any other opportunity websites such as that, some contracts are actually geared towards only women-owned business or veteran-owned business, for instance. All right, next question. With regards to the wrap rate, what is the target amount? I think so how I'm going to answer that question is that my interpretation of it, your target rate is essentially, again, what you forecast out. So typically, for me, I'd like to start to look at actual financials for the year around the October-November timeframe, and then really have last week of November and a few weeks into December to really build up what my forecasted costs are and what my forecasted revenue will look like. And then once you can establish that, then you'll be able to have target rates for your next year. So when you can establish, you know, potential RFP wins and revenue, and you know exactly how many employees are coming in, you'll have your target rate. All right, so I think that pretty much wraps it up. Once again, I want to thank you all for joining us, and Mark will go ahead and send out another email registration for the incurred cost compliance.
Yeah, as I mentioned earlier, we definitely are looking at doing another webinar that's focused all about compliance and what different regulations apply to small government contractors. So that invitation should be going out sometime in the next week or two. You might actually see it coupled with the link for this presentation. So definitely keep an eye out for that. In the meantime, if you do have any questions about either the principles of government contracting or the services that we offer, feel free to reach out to either Sean and I. So once again, thanks for attending, and we look forward to seeing you on the next one.